You still see no rate cuts this year?
We still see no rate cuts. And of course, now FOMC members are also beginning to talk about no rate cuts this year. So I do think that it's just becoming more and more difficult. If you put it together in a little spreadsheet, the growth rate that we've seen for the last 30 years for the rest of this year, you will still have inflation at around 3% by the end of the year. You need a really dramatic slowdown in inflation, 0.1 for every single month for the rest of the year to get core PCE inflation back to 2% by the end of the year. So the upward pressure on inflation is just really strong over the next several months.
We've been talking about the flip-flopping narrative. We had no landing for a lot of this year. It's been flipping and flopping depending on the day, sometimes in the same day. Then we got to Goldilocks, and that seemed to be where everybody was at for about a couple weeks. And then now people are talking about the potential for a hard landing due to economic weakness. It sounds like you don't disagree. It's just later than people expect, and it's not soon enough to keep the Fed from holding rates where they are. Is that correct?
I think that is correct, but I think that the tailwinds to the economy that are still behind us, two things, namely, we still have behind us a very strong tailwind that comes from easy financial conditions. The stock market is up $9 trillion since the November 1 FOMC meeting when the Fed began to talk about rate cuts instead of rate hikes. And on top of that, we also have a tailwind from fiscal spending. We still have strong spending in the pipeline from the CHIPS Act, Inflation Reduction Act, the Infrastructure Act. Those two things, easy financial conditions and easy fiscal policy, which, by the way, is very different from what's going on in Europe. But those things are likely to continue to give us fairly robust data, at least for the next several months, and most likely even all the way through the end of this year.